Hi all, welcome back. Today I am with another interesting topic for discussion. The topic for today's discussion is debt and equity. This is very common topic and also important one. Why? Because in most of the interviews, most of the Viva exams, this question is repeatedly asked. What is the difference between debt and equity? So in today's portion, we can learn more about debt and equity. The contents for today's discussion are debt and debt financing, equity and equity financing, difference between debt and equity, and just like all our presentation with a current scenario, we can discuss more about this topic. What is debt? Simply, what is debt? Debt is borrowed money. We are borrowing money from someone for our purposes. It may be for our personal use or it can be for our business purposes. And what is the condition for debt? Only we are paying the money back to that person or to that institution, or we are paying some more money. Yes, we are paying some more money in the form of interest. So debt involves borrowing money to be repaid plus interest. So debt is borrowing money or borrowed money which should be repaid. The condition is it should be repaid, and in what way it should be repaid? With interest. So debt is borrowed money. Along with borrowed money, we have to repay that money with some interest. Normally, the person who are borrowing money from someone will become the debtor. So the person who are borrowing money will become debtor. When a firm raises money for capital by selling debt instruments to investors, it is known as debt financing. So, if an institution is in need of capital and they are raising their capital in the form of selling debt instruments to the needed person or to the debtor. So, the person or the firm raises their capital by selling the debt instrument to the investors, then it is called debt financing. Okay? There are a lot of debt financing institutions around us. Most of the banks, commonly all the banks are debt financiers. Why? Because they are providing us money in the form of loans, mortgages, etc. So they are also debt financiers. In return for lending the money, the individual or institution become creditors and receive a promise that the principal and interest on the debt will be repaid on a regular schedule. So the finance providing institution or the debt instrument providing institution will become what? They will become creditors. The person who are borrowing the money are becoming debtors, and the person who are providing us the money will become creditors. And they receive a promise of what? They receive a promise that the principal amount, that the amount we have bought from them, that is the principal amount. The principal amount and the interest of debt will be paid on a regular schedule. We have to repay the money in a regular span of time. Within the span of time, we have to repay the money. If we are not repaying the money in a particular span of time, then it will become a great risk. That is the debtor's risk. Now we can look What is equity financing? Equity involves raising money by selling interest in a company. So equity financing is the process of raising capital. It is also just like debt financing. Equity financing is also the process of raising capital through what? By sale of shares in the company. With equity financing comes an ownership interest for shareholders. So this is also raising capital by what? By selling share. A part of ownership of company is transferred. Commonly, they will become shareholders and they have the right to get an ownership interest in the form of dividends. Equity financing may range from a few $1,000s raised by an entrepreneur from a private investor to an initial public offering on a stock exchange running into billions. Simply, I can raise capital by selling my shares to my friends, relatives, co-partner, etc. Otherwise, if my firm is a listed company in a registered stock exchange, I can sell my shares through the initial public offering. It can be for a great sum of money. Now we can look what is the difference between debt and equity. Now we had learned about debt financing, equity and equity financing. Now we can look what are the differences. Debt is not having the right for an ownership interest. Equity is having the right for ownership interest. We already studied what is debt. The debtors are borrowing money with the condition to be repaid with interest. They are not taking part in any other activities in that particular firm. They are not having any other rights in that particular institutions. So they are not having any ownership interest. But for equity shareholders, they are taking part of that particular company in the form of shares. So they are having ownership interest right. Creditors do not have voting right. In case of debt, there is no ownership is transferred, so there is no right for any caste of voting. But in equity financing, commonly all the stockholders are having right to vote for board of directors and other issues. Debt. Interest is considered as cost of doing business and it is tax deductible. It is very important. It is a very important point. Why? Because normally all the institutions are having debt. They are taking debt for this purpose. Why? Because the tax amount is deductible. The debt amount can be deductible from their tax. So interest is considered, or the debt is considered the cost of doing business, so that it is tax deductible. In case of equity holders are getting dividends, right? Dividends are the part of profit. It is not the cost of doing a particular business or something, so it is the part of profit, so that it is not tax deductible. Creditors have legal recourse if interest or principal payment are missed. This is the risk factor. This is the risk factor. Why? Because the creditors, the person who are providing the money, they have all the right to file a case against the debtors if they missed any repayment of principal amount or the interest. Within the stipulated time span, this amount have to be repaid. If it is not repaid, means the creditors have all the right to move to court and file a suit against the debtors. Equity. Dividends are not liability of the firm and stockholders have no legal recourse if the dividends are not paid. It is not a liability of the firm. It should be paid. No, if there is profit, the dividends are paid. If there is no profit for a particular firm, dividends are not paid. So there no legal issues are arising. If there are profit, dividends will be paid to shareholders. If the company is under loss, the shareholders will not get any dividend. Excess debt can lead to financial distress and bankruptcy. It is very important. Why? Because the debt is a risk factor. Excess debt, if everything is out of our hands, if it is out of our control, means the debt will become a great distress and even we can move to bankrupt. All equity firm cannot go bankrupt. This is about the common differences between debt and equity. This is just a pictorial representation of what we have studied. Equity finance and debt finance. In equity finance, there is a loss of ownership. Why? A part of our ownership, a part of our company's profit is sold to another person in the form of shares and we named that person as shareholder. So there is a loss of ownership. Here in debt finance there is a no loss of ownership exists, but in debt financing money must be repaid back with some sort of interest with a stipulated time span. In case of equity financing there is no debt, no repayment. What is done? If you are getting profit, if you are earning profit, a part of profit is given to the shareholders in the form of dividends. This is about equity finance and debt finance. Every fund, whatever it is, whether it is debt, equity, mutual fund, anything, all funds are having unique risk factors. Some of the equity fund risk factors and debt fund risk factors are given here. Equity fund risk factors, liquidity risk is there, market risk, currency risk, regulatory risk, industry risk, economic risk, everything is there. In case of debt fund risk also, interest rate risk is there, liquidity risk, credit risk, default risk, inflation risk, regulatory risk. So whatever it is, whether it is equity fund, debt fund, mutual fund, anything, what type of fund we are raising, for all fund there are risk factors. All the economic factors will be affected. The currency factors, inflation and deflation rate, everything, all the economic factors are affecting. Even some of the environmental factors too, some of the surrounding factors, the prevailing atmosphere also affect the rate of money. So this is some of the risk factors affected. And with the current scenario we can look. HDFC AMC's investors get a rude awakening during the pandemic. Now we are experiencing a very back foot time, right? It's a pandemic time now. All the economy is under crisis. Everything is down. So HDFC AMC shares underperformed the broader market this year and could even struggle in near term. Past few years' return have left some of investors disillusioned according to analysts. So according to this time, the prevailing atmosphere had very much affected the HDFC AMC's investors. Every shares have underperformed. Equity mutual fund investors who had heroic time in March and debt fund investors who were hit in a few categories in April have by and large survived the pandemic. So this is all about the prevailing economy. How our prevailing surrounding affect the fundraising. The broad equity market is down only about 7% from the pre-COVID highs and falling yields have helped return of debt fund. So the AMC's debt fund is only 7% lower from the pre-COVID high so that it helped them to repay the debt fund. In the June quarter, HDFC AMC's yield reflected the sluggish equity segment. So they are experiencing very sluggish equity segment in the June quarter. Why? Because the COVID rate is very high during this time. Shares the fund house are underperformed in broader market this year and could even struggle in the near future. So the financial analysts are telling even in the near future also this risk factor, that is this economy will struggle. Why? Because this problem need to be solved completely and the economy need to be replenished after that, so that the struggle will continue for a long period of time. The HDFC AMC stock has dropped 28% from the pre-COVID highs, while the Nifty 50 is down just 6.5. So their stock has dropped 28% during this time. HDFC AMC's market shares in equity assets under management have slipped from about 15.7% in April 2019 to about 14% in 2020. So here also it is slipped to 14% from 15.7%. As equity products have a higher yield and reduction have a large proportionate impact on profitability. By studying all this portion, what we have understood, whatever it is, whether it is equity fund, debt fund or any other type of fund, everything is having their own risk factors. As creditors, as debtors, we should be very cautious regarding raising fund. With a cautious mind, we can raise fund for our purposes. With this, and concluding my topic, thank you all. Next week, I will come up with another interesting topic for discussion. Till then, bye.